Hello, everyone, and welcome to today's webinar on lessons learned from enforcement actions. My name is Danny McGlynn, and I'm the president of the Institute for Financial Integrity. IFI's mission is to protect the financial system from use by illicit actors and to combat threats to collective security through cutting-edge research, training, and education. It's great to see so much interest in this topic. We have people joining today from 16 different countries at last count, from both the public and private sectors, and especially from financial institutions of various sizes. So good morning, good afternoon, and good evening to everyone. We appreciate you taking the time to be part of this important discussion, and we hope you could take away some valuable information and insights. Before we begin, let me quickly go over a few housekeeping items. Today's webinar is being recorded, and we'll share the link with you after in case you miss anything or want to revisit something or share it with colleagues. Please feel free to submit questions using the Q&A tab on your screen. We'll try to address as many as time permits, including during the Q&A segment at the end. And thank you to those who did submit questions ahead of time, and we've worked some of those into our discussion and cover as many as possible. Finally, you'll also notice an area for documents, which includes some key resources associated with the cases that we're going to go over today. So feel free to check those out for more information. Introductions are going to be quick today because it's Catherine and I who are going to tag team this session. For those of you who don't know her already, Catherine Woods is an associate managing director here at IFI and serves as our subject matter expert on cartels, Chinese money laundering networks, illicit procurement networks, and many other things as well. Catherine has spent more than 15 years in senior and specialist positions in global banks and fintech startups in Australia, London, Hong Kong. Her background is much more interesting than mine. She was a financial intelligence and investigations senior analyst at HSBC, led public-private partnerships and outreach programs at Standard Chartered Bank, and represented financial services at the UK's Joint Money Laundering Intelligence Task Force, or JMLIT, a world-leading public-private intelligence sharing partnership. So let's take a quick look at today's agenda. We chose 7 different case studies. We've got a good mix of some of the record-breaking multi-billion-dollar penalties in recent years, a professional crypto money launderer who was indicted a couple months ago by the Department of Justice. We'll dig into the historic FinCEN orders targeting 3 Mexican financial institutions last year. And we'll also discuss lessons learned from recent AML and sanctions enforcement actions by UK authorities. And we'll close with questions and answers. So let's go ahead and jump in, starting with Binance. We thought the Binance settlement is a good place to start. Even though it was a couple of years ago, this still represents the largest settlements in history by FinCEN and OFAC with the world's largest digital currency exchange. Both Binance and its founder and CEO, who is known by his initials CZ, pled guilty to failing to maintain an effective AML program in violation of the Bank Secrecy Act. CZ also agreed to resign as the CEO, pay a $50 million fine, and this was on top of the $4.3 billion paid by Finance, and he served 4 months in a California prison. I also like this case because Binance seems like an incredible comeback story. Not only has the company made a ton of upgrades to its AML and sanctions compliance programs, but it's still the world's largest crypto exchange, reportedly worth around $100 billion, which is roughly 39% of market share. And CZ now ranks as the 17th wealthiest person on the planet, richer than Bill Gates, according to the latest Forbes estimates. So let's dig into the enforcement action, what went wrong, and what Binance has done to correct it. The settlement included 3 main prongs. You could go, yep, here's the right slide. These are the 3 main prongs: the guilty plea to federal charges, the FinCEN settlement, and the OFAC settlement. I call it the trifecta. So the DOJ investigation was settled with a guilty plea that Binance willfully violated the Bank Secrecy Act, failed to register as a money services business and violated the International Emergency Economic Powers Act, or IEPA, which is the main economic sanctions statute. FinCEN settlement agreement assessed a historic $3.4 billion civil penalty. They also imposed a 5-year monitorship and required significant compliance undertakings, including to ensure Binance's complete exit from the United States. Binance also agreed to a look back to identify and report to FinCEN the suspicious transactions that it processed and failed to report. OFAC's settlement agreement assessed a penalty of $968 million, which surpassed its previous record of $963 million charged to BNP in 2014. And it required Binance to abide by a series of robust sanctions compliance obligations, including full cooperation with the monitorship overseen by FinCEN. The monitor is overseeing remedial actions necessary to address Binance's failures to comply with its AML and sanctions obligations. And as part of this, it conducts periodic reviews and reports to FinCEN and OFAC and CFTC, by the way, on its findings and recommendations to ensure Binance's ongoing compliance with the terms of the settlement agreements. And one last important thing I want to point out that's not included on this slide is the important role played by the IRS criminal investigation. IRS CI special agents actually led the criminal investigation into Binance and CZ that served as the basis for the criminal charges and civil penalties. The next slide shows the main compliance failures by Binance and the impact of those failures. Regarding its failure to establish, maintain, and implement an effective AML program, Binance had inadequate KYC procedures, inadequate transaction monitoring, and it failed to report suspicious transactions. Specifically regarding KYC, Binance allowed some customers to create accounts by providing only email addresses and did not conduct customer due diligence. Even more egregious, they instructed some customers on how to change their KYC information to hide their links to the US and avoid regulatory requirements. And as a result, Binance processed the proceeds of a variety of criminal activities, including ransomware attacks, large-scale hacks, and other frauds and scams, and it failed to identify associated suspicious activities, which significantly impeded law enforcement investigations. Regarding its failure to implement an effective sanctions compliance program, Binance did not have adequate tools to screen IP addresses. It onboarded customers with incomplete data, and it failed to integrate sanctions lists into their transaction monitoring systems. More egregiously, Binance managers encouraged users to bypass controls, including using virtual private networks or VPNs to evade geolocation restrictions. And I would note that more recently, in December of 2025, OFAC penalized Exodus Movement, a Nebraska-based fintech company, in part for the same thing. In some cases, Exodus staff recommended that Iranian users utilize VPNs to obscure their location and bypass sanctions-related access restrictions. As a result, Binance processed over 1.6 million transactions involving all kinds of sanctioned jurisdictions and actors, including Iran and North Korea and Al-Qaeda and ISIS. And on the next slide shows it's important to note that Binance has come a long way in the past couple of years. It's significantly increased its resources dedicated to AML and sanctions compliance. It spends about $200 million each year and has hired hundreds of more compliance professionals and invested in technology, training, and program upgrades. According to its own metrics, which they publish, Binance has been able to reduce direct illicit exposure by 96% and sanctions-related exposure by 96.8%. I don't know exactly what's behind those numbers, and their starting point was obviously lots of direct exposure, but it seems like good progress nonetheless. What's more interesting and exciting to me is the more tangible stuff, which Binance also puts out on their website. So they processed 71,000 requests in 2025 and conducted over 400 training sessions for law enforcement organizations around the world, which is great. And they have a lot of case studies out there where their team has helped authorities take down notable fraud, human trafficking, and other illicit networks and confiscate over $130 million. So with that, I'm now going to turn it over to Catherine to talk about the Figura indictment.
Thank you so much, Danny. And yes, we're going to talk about the indictment of Figura, which happened in January. But let's move to the next slide and step through what we're talking about in terms of the scale of illicit finance and where crypto fits in with that. So there's estimates are that there's about $4.4 trillion in global illicit activity. Obviously, the objective of those involved is to hide what they're doing. So it's a very rough estimate, but it's a very big number. And that's estimated to be growing at about 19% a year. So the sources of this illicit activity include things like drug trafficking, which is about $1 trillion, human trafficking, which is about 500 billion. There's also things like environmental crime, sale of counterfeit items, about $500 billion in 500 billion in fraud. Traditionally, that's not considered a financial crime or hasn't been considered a financial crime, but the proceeds need to be laundered as well. And there's increasing connections between fraud and money laundering. And the same methods used to launder money are also used to evade sanctions. So even if the underlying business activity might be legitimate, when that money is moved in breach of sanctions, then that's illicit activity as well. And similar methods are used to launder money. So some of the trends that we see are an increasing professionalization of laundering. So that means individuals help criminals launder the proceeds of crime, and they take a fee for doing that. And laundering is their specialist skill set. So they're not necessarily involved in the predicate offences like drug trafficking or human trafficking. They just launder the money. And what this means is increasing risks to financial institutions and other regulated businesses and other businesses generally, because these professional money launderers they're really expert at what they do, and they're very good at understanding how the financial system works, the kinds of controls that are in place, and how to evade them. And we'll see that when we step through Figura. So these professional launderers look for all different methods to launder money, and they continue to evolve and adapt those a little bit comparable to a legitimate financial institution. They're always looking to expand their products and services and give better customer service, or professional money launderers thinking with that same kind of mindset. So overall, crypto adoption is increasing, meaning the use of crypto is becoming increasingly prevalent. Illicit activity is still a really tiny proportion of that. So less than 1% of on-chain activity is estimated to be illicit, but that still means billions of dollars. So still significant in terms of absolute numbers. And what we're seeing are some trends in the way that crypto is used in laundering. So about 80% of it now uses stable coins. So stable coins are pegged to a fiat currency, often to the US dollar. And one example of that is Tether. Previously, coins like Bitcoin were used, but they're very volatile, meaning their value changes rapidly. So stable coins are increasingly used in laundering. And there are on-ramps and off-ramps between the traditional financial system. So maybe cash is used at the start, but then it's off-ramped into a bank account. And that's because these criminal networks use crypto to launder, but they don't necessarily want crypto itself. Like they're not, they want fiat currency in the financial system. So that sets the scene on crypto. And now let's move forward and have a look specifically at the Figura case. So Figura is a professional money launderer. He's Venezuelan, and he was indicted by the DOJ in January. So what we need to be really clear about as we speak through this is it is an indictment. A person is presumed innocent until they're proven guilty. So what we're speaking about are the allegations and statements made in that indictment, which have not yet been through the court process. The allegations or the evidence presented in the indictment is that Figura's network laundered almost $1 billion. And you can see some of the indicators on the slide of the scale of laundering that he could support. Now, these are statements that he made. They were recorded by law enforcement, and they have been translated from Spanish into English. But these are his statements. So they might be accurate. They might also be talking us to potential how household impressions to be service legislator and the United States. And there's some really interesting comments that he has made as part of those recorded conversations. One of them is do you know who has excellent technology and tools to do money laundering? The Chinese, but we do too. Now, if you've joined other webinars, you will have heard me speak a lot about professional Chinese money laundering networks, and we'll even touch on that later in this webinar. But it's really interesting to see another professional launderer commenting on his competitor professional money laundering networks. So let's now dig into a little bit more detail on the process that he used for his laundering. We have a 4-step process that's shown here. This 4-step process is my analysis of what's presented in the indictment. So different people might kind of divide these steps differently. Step 1 is cash deposits. These were primarily made into Panama and Venezuela. They included the proceeds of narcotic sales and counterfeit fashion accessories, and also commercial activity where the money was being laundered to evade sanctions. And the reason he focused on depositing cash into Panama and Venezuela is because those are very cash-focused economies and it attracts less attention. And he specifically stated that it was more difficult to deposit cash in the US because of the level of scrutiny. And so the network that he was part of would charge more money for US cash deposits. So that's one of those first indicators of this launderer's knowledge of how the financial system works. Step 2 is to convert that cash into crypto. Primarily, he used Tether on the Tron blockchain. And step 3 is to layer that crypto. So just like fiat currency layering, you move it through lots of different bank accounts. In crypto, you move it through different addresses or wallet addresses. What you're trying to do is to obscure the trail. So Figueira, on average, moved each crypto 4 to 9 times, and that was moved really quickly, just the same as fiat currency. So in one case, there were 9 movements of that crypto within just 22 minutes, so very fast. Each of these movements incurs a fee. Like each time you do a movement on a blockchain, you pay a fee for that. So if you were a legitimate person, you would try and minimize the number of crypto movements that you do to minimize your costs. So this is a red flag of illicit activity. So lots of movements, those are incurring costs. So it's an indication that's illicit activity. And obviously on a blockchain, or specifically this blockchain, that's visible. So if you're using blockchain analytics, you would be able to see that activity. Finally, the crypto ended up in Figueira's macro wallet. That's what he called it, his macro wallet. About $1 billion worth of crypto entered that wallet, and about $1 billion was moved out of that wallet. So basically what he's doing here is he's pooling all of that crypto before he off-ramps it via step 4. So step 4 is his off-ramping process. He used OTC brokerages, so that's over-the-counter brokerages. He called them liquidity providers. The significance of using OTC brokerages rather than exchanges is that OTC liquidity providers can handle large volumes off market without affecting prices. So it's if you're transacting large volumes, that's a effective way to off ramp. He actually refers to Enigma, Anchorage, and Abra. They're all regulated in either the US or the UK. That I have not seen anything indicate that has been validated. So again, these are his statements that he's using those brokerages, but he may be just saying that because he wants his clients to think he's using reputable exchanges rather than some of the sketchier exchanges in the world, like Russian affiliated exchanges. So he mentions those names, but we don't have any data on which exchanges were actually used or whether those ones were actually the ones that he was using. So Figueira had at least 4 shell companies. At least one of those was in the United States, and he intentionally chose business descriptions to minimize attention. So he used what I would describe as financial services adjacent businesses. That means he uses descriptions like credit company or trade finance consulting. He specifically did not refer to money transmitter because he said that would attract bank attention. And the characteristics of these shell companies, where there is a lack of legitimate transactional activity, like payroll, lots of inflows from crypto platforms, rapid outflows to high-risk jurisdictions like Colombia, China, Panama, and Mexico. And there was about $2.8 billion moved through those accounts over about a 2-year period. So So now let's look at the red flags. We've touched on some of these already. So one red flag is shell companies. These are companies that don't appear to have staff or operations, even if they have a website. Transactions don't include legitimate business activity, so it's a business account, but there's no payroll or business expenses. And the red flag that we could pull out from Figura is that the business is in a finance adjacent sector, like trade finance, consulting, or credit. If we look at the transactional red flags, we can see indicators of pooling or funneling. For example, the inflows are equivalent to outflows, especially when they are high value, high volume, or high velocity. The inflows or outflows aren't consistent with the business type, or they involve high risk products or jurisdictions. And the crypto transactions, which you can see on the blockchain, involve multiple movements in the absence of a business rationale. And as we said, that incurs costs. So that's a red flag that there's something illicit going on. We've touched on a number of ways in which Figura had expert knowledge of banks and their controls. So let's just highlight those in a little more detail. He references knowledge of US laws, including the Patriot Act and their implications for his laundering networks. He knows how to exploit variations in regulation and enforcement across different jurisdictions, like which countries can accept cash deposits without attracting attention. He knows about the bank due diligence processes and how to make shell companies appear legitimate, like websites. He knows about bank risk rating methods, like the types of business that attract attention and how to use descriptions that attract less attention. And he also understands blockchain analytics and how it can be used to identify wallets associated with illicit activity. And he makes statements in this indictment that he's actually monitoring wallets to identify if any are frozen and to adapt his methods accordingly. So what can financial institutions do? Implement crypto-specific measures, even if your exposure is indirect. So you might be not directly be an exchange or offering crypto services, but if you have clients who do, or you're seeing crypto-related transactional activity, make sure that you have measures in place to assess those risks. If you do see red flags, conduct enhanced due diligence that includes these crypto-specific methods. Some of those can be blockchain analytics, doing investigations or screening, and that's both at onboarding as well as ongoing when you have more information about the customer's transactional activity. You should identify and investigate potential shell companies. This is not specific to Figura. Shell companies are used to perpetrate all kinds of illicit activity, have been for many years. So this should be something that's well embedded in your institution's framework already. And I would say the final point is to just recognize how sophisticated these professional money laundering networks are, and that they really understand your processes. So, you're up against quite skilled adversaries, and need to invest resources to make sure that your controls and your programs are proportionate to protect your institution and your customers. So we've covered a lot of crypto so far in the webinar, or crypto-related businesses, as well as their touch points to the traditional financial system. So now, Danny, I will hand back over to you to pivot to some banking case studies and what the issues were that were identified and the actions that are being taken to remediate that.
All right, bring it. So we thought it was important to include the enforcement action against TD Bank for a few reasons. One, it was the largest penalty against the depository institution in the United States in Treasury and FinCEN history. Second, it became the largest bank in U.S. history to plead guilty to Bank Secrecy Act program failures, and the first U.S. bank in history to plead guilty to conspiracy to commit money laundering. Similar to Binance, TD has made a lot of progress since the penalty, and I think it's important to make note of that as well. So on the next slide, you could see the basic layout of the penalty. So this one was different than Binance because it did not involve sanctions violations, but there was another trifecta of major coordinated actions. A DOJ criminal case, a FinCEN settlement, and an OCC cease and desist order. TD Bank agreed to $1.8 billion criminal penalty, and combined with the civil enforcement actions that were announced simultaneously, the U.S. imposed a total penalty of approximately $3.1 billion against TD Bank. The bank also agreed to the imposition of a 4-year monitorship and to conduct an AML program review and SAR lookback review. And for the first time ever, FinCEN imposed what they called an accountability review to independently assess the involvement or failure to escalate by TD Bank personnel, and what they called a data governance review to help ensure that TD Bank identifies and fixes the root causes of the many gaps in its AML program. Finally, the OCC issued a $450 million civil penalty and a cease and desist order that included an asset cap and business restrictions. The business restrictions include getting the OCC's approval, essentially, prior to opening a new branch, entering a new market, or adding new products and services. Next, we'll show some highlights of what went wrong. On the transaction monitoring and reporting, TD added no new added no new scenarios, despite adding new products and services, and it excluded ACH and check activity from automated monitoring. There were large backlogs of alerts and SARs, and an estimated 18.3 trillion in transactions went unmonitored over 6 years. Some examples of high-risk clients that took advantage of TD were precious metals companies in New York that deposited large amounts of cash that did not match their customer profiles. The regulators also cited a real estate company that had an expected sales of less than $1 million and expected wire transfers of less than 25,000 that actually conducted over $1 billion in transactions from a UK crypto exchange to a Colombia virtual asset service provider. There were also a number of complicit employees, some of whom allegedly facilitated narcotics-related money laundering in exchange for bribes. According to the regulators, they set up over 2,000 accounts and helped process over $200 million in 600,000 transactions. As shown on the next slide, 2 former employees actually pled guilty this past January, and their sentencing is scheduled for May and June. One was involved in what's become known as David's network, and the other was involved in the Colombia-related money laundering. Over 3 years, Da Ying Shi, who was known to TD Bank employees as David, moved $470 million in illicit funds through TD branches. He pled guilty in 2022 to conspiring to hide proceeds of narcotics trafficking. David conducted most of the transactions in large sums of cash, which he often brought in bags to TD Bank branches. On multiple occasions, he deposited more than $1 million in a single day and immediately moved the funds out through official bank checks and wires. David used multiple other banks as well, but he reportedly used TD Bank most of all because he found its policies and procedures to be the most permissive. David also bribed TD employees with over $57,000 in gift cards. One of those employees was a Manhattan, New York store manager who pled guilty to facilitating money laundering on January 6th. He processed over 1,600 official bank checks for David's network, totaling more than $92 million, as well as 3 transactions of about $2 million. He accepted 11,000 in retail gift cards for facilitating the scheme and failed to report David as the conductor of the transactions in CTRs and SARs. The other former TD Bank employee who will likely be going to jail soon worked for a branch in Doral, Florida, an area I happen to know well being from South Florida. He pled guilty also in January to accepting bribes and laundering more than $5.5 million to Colombia. He allegedly received $6,000 in bribes and was responsible for opening fraudulent accounts, issuing over 150 debit cards to shell companies, and unblocking debit cards that TD Bank had restricted. The bank accounts and debit cards were used to make more than 12,000 ATM withdrawals in Colombia. But in better news, as we show on the next slide, the enforcement action was obviously a huge wake-up call, and TD Bank has spent significant time, effort, and resources to improve their AML program. TD Bank committed over $500 million to remediation costs in 2025 to overhaul its U.S. AML program and improve its enterprise AML program. And it's expected to continue with similar or even higher investments in 2026. I won't go into too many details, but as you can see on the slide, they've made significant improvements in governance, risk assessments, policies, processes, and controls, data and technology, and to my mind, and most importantly, people and talent, including lots of great new hires, new role-based targeted training, and revised bank-wide general training. I have no doubt that many of you who are watching and work at TD Bank are part of this massive change in culture and ultimately performance. I have a lot of friends and former colleagues there, and I know it's an exciting time to be a financial integrity professional working at TD Bank, and we're expecting to see great things. Next, I'm going to go back, down a bit of a different path here and talk about the special measures imposed by FinCEN last year on 3 Mexican financial institutions, Sabanco, Intercam, and Vector. On June 25th, FinCEN issued orders identifying these 3 entities as being of, quote, primary money laundering concern in connection with illicit opioid trafficking. So these were the first actions by FinCEN pursuant to the Fend Off Fentanyl Act. And essentially, FinCEN has ordered U.S. financial institutions to stop any and all transaction of funds to or from Sabanco, Intercam, and Vector. Before I dig into what FinCEN found that led them to issuing these orders, I thought this would be a good opportunity to take a step back for a minute and review the differences between OFAC sanctions designations and FinCEN special measures. I think a lot of you are very familiar with OFAC sanctions designations, maybe a little less so on FinCEN special measures. So we created this chart to compare them and show some of the important distinctions. I'll give a Cliff Notes version now, but if you're interested in more detail, let us know, and we'll also be making the chart available after the webinar as part of the entire slide deck. I think somebody asked that in the chat as well. So once this is over, we'll share a version of the deck with folks. So designations pursuant to sanctions programs could stem from a variety of different authorities, but the most common one by far is IEPA, the International Emergency Economic Powers Act, which I mentioned earlier that was part of the Binance fine. IEPA provides the U.S. president with the authority to declare a national emergency with respect to an unusual and extraordinary threat to the national security, foreign policy, or economy of the United States, and the authority to impose sanctions in order to deal with that threat. So the president usually delegates the authority to administer and enforce the sanctions to the Secretary of the Treasury, who in turn delegates it to the Director of OFAC. And the 3 main tools that OFAC utilizes to administer and enforce those sanctions are the blocking of property, the prohibiting of transactions, and demanding information through administrative subpoenas. So as part of many sanctions programs, specific individuals and entities are designated as subject to sanctions, and they are included on OFAC's SDN list. All U.S. persons, including but not limited to financial institutions, are required to block their property, and that includes bank accounts, and are prohibited from engaging in transactions with them. And the blocked assets or rejected transactions are reported to OFAC. Special measures imposed by FinCEN are different. They're narrower than sanctions in a couple of key ways. So instead of all persons who must comply with sanctions, special measures apply to covered financial institutions. And instead of requiring the blocking of all property and prohibiting transactions, through special measures, FinCEN has to select from a menu of narrower options, including requiring additional record keeping, information collection, or reporting requirements, or the most significant option, prohibiting financial institutions from opening or maintaining correspondent accounts. Most special measures imposed by FinCEN under Section 311 of the U.S. Patriot Act have invoked this option, which you see in bold in the chart. This essentially severs their access to the U.S. financial system. The most recent example was the proposed rule on February 26 to prohibit covered U.S. financial institutions from opening or maintaining correspondent accounts for or on behalf of MBER Merchant Bank in Switzerland for providing, and they did this, MBER was providing financial support to Iran and Russia. So what's interesting is that Treasury opted to use 311 authority here rather than OFAC sanctions. And I think we're going to see more FinCEN actions like this in the future. So it's important to understand these distinctions. The Fend-Off Fentanyl Act takes it a bit further, if you will. The identification of the primary money laundering concern needs to be in connection with illicit opioid trafficking. And in addition to the 311 options I just described, it also gives Treasury the authority to require covered financial institutions to cease any and all transfer of funds to or from the target. And that's exactly what FinCEN did with respect to Sabanco, Intercam, and Vector. So for example, if your institution comes across a wire transfer request to process funds to or from Caramit Bank, which was designated by OFAC, you're required to freeze the assets and report it to OFAC unless otherwise licensed. Whereas if you come across a wire transfer request to process funds to or from Sabanco, you should reject it. There's no reporting requirement for OFAC. And while filing a SAR with FinCEN is not required, I would highly recommend it. So the next slide shows an overview of what FinCEN found that supported their findings that Sabanco, Intercam, and Vector were primary money laundering concerns in connection with opioid trafficking. Their findings were based on a combination of a couple things. First, sensitive law enforcement or intelligence information indicating that these entities provided financial services to or otherwise supported designated narco-terrorist organizations. And two, bulk financial intelligence, possibly from SAR reporting from correspondent banks, indicating that they processed transfers that facilitated the procurement of precursor chemicals from China. So for example, according to FinCEN's findings, a Sabanco employee facilitated the opening of a bank account to launder $10 million on behalf of the Gulf Cartel. The Gulf Cartel was one of the 6 Mexican drug trafficking organizations that were designated by the United States early in 2025 as foreign terrorist organizations. And so was the Jalisco Cartel, whose notorious leader El Mencho was recently killed in Mexico. According to FinCEN, Intercam executives met with Jalisco Cartel members to discuss money laundering schemes, including transferring funds from China. So this kind of information, to my mind, would have come from law enforcement or intelligence sources. In addition, the FinCEN 2313A findings also cited bulk financial intelligence, like we have displayed on the next slide, which details how Sabanco processed transfers for 6 different Mexican companies to send over $102 million to companies in or near China to procure precursor chemicals that the cartels use to produce fentanyl and other illicit narcotics. I think there's a good chance that most of this financial intelligence was provided by U.S. correspondent financial institutions that were either filing SARs or reporting to law enforcement requests for information. This shows the importance of BSA reporting and information sharing by financial institutions. We don't have time today to walk through red flag indicators to detect these kinds of transactions, but FinCEN has issued several reports with detailed guidance on this over the past few years. So if you simply Google FinCEN and opioid, a few of those guidance documents should pop up. Okay, next we're going to look at a couple of UK enforcement case studies, starting with Monzo, which Catherine is going to cover.
Fantastic. Thank you, Danny. So let's have a look, first of all, at just to center ourselves on what is Monzo. So Monzo is could be called a challenger bank, could be called a fintech. These are businesses that offer financial services with improve customer experience, often based on technology. They may focus on apps, or they may be digital only. So they are challenges to traditional financial institutions. They're often characterized by very rapid growth and quick evolution of products and services. And one of the implications of that can be that part of their account opening processes, to make those very quick and streamlined and customer friendly. Sometimes it means that they are not gathering sufficient information on their clients to identify which ones are high risk. And obviously that's a key input into monitoring that client's activity and making sure that you apply appropriate levels of due diligence. So now let's look specifically at Monzo. Now that we've set the scene. So Monzo is headquartered in the United Kingdom, and it experienced really exceptional growth. So it grew from 250,000 customers in 2017 to 12 million customers in 2025. And its products changed from being its initial product offering, which was prepaid payment cards, to cover personal current accounts, business banking, overdrafts, loans, and money transfers. In July 2025, it was fined £21 million, so that's around $28 million, by the UK regulator, the Financial Conduct Authority, because its financial crime controls didn't keep pace with customer and product growth. And it was one of several fintechs that experienced similar penalties. So just to put that into context, Monzo was not alone in these findings. So now let's have a quick look at some of the specific weaknesses that were identified by the FCA. So what the FCA identified was that the customer risk assessment and collection of customer information weren't adequate given the growth of their client base and their products and services. So some of the deficiencies, and these applied to different groups of customers, were that they did not get information about the purpose and nature of the relationship. They didn't view adverse media hits unless some other risk factor was present, and they didn't verify customer addresses for some types of customers. So, for example, some customers use implausible addresses, like 10 Downing Street, which is where the Prime Minister lives. We have a nice picture there, including Larry the cat. Some of the other addresses used were Buckingham Palace and Monzo's own offices. So clearly addresses that were not the addresses for those customers, and that's something that should have been picked up. They also didn't identify the beneficial owner of some business customers. So that's the kind of gaps in the CDD process. Their processes also didn't set out clearly when enhanced due diligence was required, or define what was a politically exposed person. So if those aren't embedded in your processes, your teams are relying on their own judgment or their own experience. And the effect of that was that of these deficiencies that we've spoken about was that Monzo wasn't able to effectively monitor customer transactions to identify suspicious activity. And some of the key transaction monitoring tasks were performed by staff who didn't have the level of experience or the training needed to do that job. So the implications of this were, there's actually like another step in this. So in August 2020, the FCA required Monzo to review its financial crime management processes and imposed a restriction on accepting new high-risk customers. So this was kind of the warning, but Monzo unfortunately did not quite fulfill that requirement, and instead opened more than 26,000 more high-risk accounts, and it didn't adequately monitor or test its compliance program. So this is where the FCA then stepped in and said, well, we're going to impose a penalty. We gave a kind of a warning to to self-assess and self-remediate. That was not fully effective. So they imposed a penalty, as we say, £21 million. They were also required to establish and complete a financial crime remediation program. So one of the key points here is that for a financial institution is that as your products and services evolve, and as your customer base grows, whether you're a big institution or a small institution, you need to make sure that your financial crime program scales accordingly, and you need to make sure that you have sufficient resources with sufficient experience and training to meet that growth. If you don't, what happens is quite possibly you'll get a penalty from your regulator. You will then incur extra costs in remediation program, more resources. So there's not just the direct penalty, but there's all the extra costs as well. And of course, fundamentally underpinning this is your institution is being used by illicit actors, potentially to engage in criminality or other types of illicit activity. So definitely not something that you want to have happening. So that's a broad indication of the consequences. We don't have, it's not as though there were specifics for Monzo about illicit activity, but that's the underpinning of these kinds kind of programs. So continuing with the UK theme, I'm going to hand back to Danny to speak about another case study from the UK.
All right, thank you, Catherine. This is our second to last case study. So we're going to take a quick look at the Bank of Scotland case, which recently resulted in a £160,000 fine by the UK's Office of Financial Sanctions Implementation for Russia sanctions violations. This occurred just over a few weeks in early 2023, so we laid out a timeline to show what happened here. On February 6th, the Bank of Scotland opened an account for a British citizen who used a UK passport for his identification. The individual was actually a designated sanctions target. However, an automatic sanctions alert was not triggered because the name on his passport wasn't an exact match for the name of the person on the UK sanctions list. It contained a changed character and an additional character in the first name, a missing middle name, and a changed character in the last name. And the character changes are common equivalents in Russian to English translations. On February 7th, the name variant used to open the account triggered a match against the commercial PEP list entry. And this was followed by a manual adverse media check on February 20th, which identified the customer as a designated person. However, due to human error, the individual was incorrectly assessed to have been removed from the UK list. I think what happened was he was removed from the EU list, but remained on the UK list. And what's important to note here is that the results of the PEP review and adverse media check were not escalated to the sanctions team. Meanwhile, between February 8th and 24th, Bank of Scotland processed 4 payments totaling £76,000, crediting the account, and 20 payments totaling over £1,000 debiting the account. OFAC later determined that the processing of these payments violated Russia sanctions regulations. And finally, on February 24th, as part of an internal investigation of a related account, the customer was identified as a designated person. The bank then promptly restricted the accounts and notified OFAC on March 10th of the potential breach and formally disclosed the violation on March 16th. OFAC actually published a blog last month highlighting 4 key lessons learned from this case, which we'll display on this slide. So first, screening data and configuration really matter. So you should make sure your screening can account for spelling variations and transliterations, and where risk justifies it, you should consider enriched screening solutions and commercial list providers. Second, automation is not a safety net, so make sure staff know when and how to escalate. In this case, the PEP review team that identified the customer as a potential sanctions target should have alerted the sanctions team. Third, training must be kept up to date. In this case, OFAC found that the Bank of Scotland's training did not reflect the risks associated with the current sanctions risk landscape, especially the heightened risk posed by Russia sanctions after 2022. And finally, voluntary disclosure can make a big difference. In this case, Bank of Scotland voluntarily disclosed the potential breach and the actual breach, and OFAC rewarded them with a 50% discount on the penalty. So that's Bank of Scotland, and now I'll hand it back over to Catherine to close us out with the Wynn Casino case study.
Fantastic. Thank you so much, Danny. So last case study for today is the Wynn Las Vegas Casino. We will try and leave a bit of time for Q&A, so I'll step through this one fairly quickly. So to set the scene, let's look at the scale of global gambling revenues. They're estimated to reach somewhere between $200 to $700 billion over the next few years. In the United States, commercial gambling and gaming is about 72 billion, and tribal gaming is on top of that, so that's about 44 billion. We've seen action taken by the US government, the government of Mexico, against gambling establishments that are being used to launder illicit proceeds, particularly from cartels. And this kind of action is being taken in the United States as well. So now let's look at the specifics of the Wynn Las Vegas. The Wynn Las Vegas was subject to a $130 million forfeiture in 2024. And this started with a tip in 2018 to the IRS that a casino host was involved in unusual behavior involving third parties at the casino. This was investigated, and it was found that Chinese money laundering networks were operating in the casino. The way that this worked was that money processors received US dollar cash from customers in Vegas, and this was the proceeds of various types of illicit activity. There were Chinese gamblers wanting cash to gamble in the casinos, and those who have joined webinars before will understand how capital flight from China operates. And also in the case of gambling, those gamblers want cash in the casino. It's actually, there are practicality and security concerns of moving large cash around. So what they really want is just to get the cash on the spot in the casino. But they can't move it via wire transfers from China because there are capital restrictions. We also, it's worth mentioning, we have a lot of documents in the downloads here. So if you want to go to the download section, there's a more detailed analysis of Wynn, also the Figuera case study that we spoke about earlier, and the case studies that Danny's been speaking through. So some extra resources there if you do need that extra bit of detail. So back to the laundering methodology at the Wynn. There would be a meeting between a casino host, one of these money processors, and a gambler. This would occur in a hotel room, a hotel bathroom, or a vehicle. The gambler would be sold US dollars in cash, and they would pay for that using a mirror transfer, using online banking or a banking app. So they would move money from their Chinese bank account to a Chinese bank account controlled by the Chinese money laundering network money processor, and the gambler goes back to the casino floor, exchanges the money, the cash for chips, and continues with their play. Quite often the casino host would get a cut as well. They knew exactly what was going on in these transactions, so they were complicit employees, and that's something to really be alert to. And the cash that they received at the Wynn was not just used at the Wynn, it was used at other casinos as well. So that's the kind of core methodology. Now, if we look at some of the other weaknesses in the Wynn's compliance program, there were intermediary shell companies and nominees being used to launder money. So these were third-party agents contracted by Wynn to recruit foreign gamblers. They moved funds through companies, bank accounts, and third-party nominees. Often these businesses had kind of implausible business activities. Like there was one that was a furniture company that wired funds for 35 Wynn patrons. So supposedly this was, the proceeds of their business activity. That's so red flags should be going up. This is a furniture company that 35 different Wynn patrons their accounts are receiving money from. They also used proxy gambling, so it's also called human head gambling. This is where a patron was unable or unwilling to conduct transactions in their own name. So another person would sit at the gaming table, and their play would be directed by the person. So one person's like the proxy. And the Wynn also did not file sufficient SARs. So there were 1.4 million in transactions for someone who had been linked with proxy gambling. They were denied entry to the United States due to suspected associations with organized crime. And the Wynn president of marketing was actually with them when that happened. So should have raised red flags, should have prompted filing a SAR. They didn't report transactions for an individual who had spent 6 years in prison in China for violations of financial laws, and that was publicly reported as well. And there were other individuals who were, had been reported and identified in the US media as being involved in proxy gambling. So none of these resulted in SARs, and obviously they should have. So just to recap now on the consequences of these control weaknesses. 130 million in forfeiture. They were required to put a remedial compliance program in place, including more staff, enhanced training and technology, and to undergo an external compliance review. And additionally, the casino staff who had been complicit were terminated, and there was up to $500,000 forfeiture and or imprisonment for the money processors, so the Chinese money launderers who had been involved. So the actions to take here, monitor for unusual patterns. That includes staff gamblers and third parties. Monitor for unusual transactional patterns, conduct due diligence on deposits that are coming in from companies to see whether those patterns seem legitimate, and include open source searches in your due diligence. So I know that we've had a few questions coming through on the chat, and we had some questions come through during the registration as well. So might hand back to you, Danny, to see if we have time for a couple of those questions.
I think we do. And so I'm going to try to combine, as usual, a lot of interest in crypto. So we had a question come in through registration and a question come in during the webinar, which is similar. So I'm going to try to combine them into one. And it's about how sort of both crypto exchanges and sort of digital clearing counterparties or correspondent banks can protect themselves from the typologies or methods used like by Figuera that you were going through earlier to launder money through digital assets. So maybe you could take that one, Catherine.
Yeah, absolutely. Thanks for the question, Danny, and thanks to our audience for raising those questions as well. So the key activities, if we're thinking about crypto exchanges, are do really good due diligence on your entity clients as well as your individuals. That includes looking for indicators that they are shell companies, because shell companies, as we said, are used to perpetrate all kinds of illicit activity. Use blockchain analytics. If you're a crypto exchange, you will definitely be doing this, or you should be doing this. If you're a financial institution, then you should also integrate blockchain analytics if you either offer crypto products or services, if you have clients in those sectors, like if you're targeting them, for example, as part of your target client base, or if you see indications of high risk crypto activities like large inflows from crypto exchanges or outflows that aren't proportionate to what you would expect for that client. And as either a crypto exchange or a financial institution, look for unusual activity. We spoke about layering movements on the blockchain, but equally traditional financial institution, if you're through your bank accounts that you're seeing, look for unusual transactional activity, like indications of shell companies. As a correspondent bank, you will need to rely more on the due diligence programs of your respondent banks. So suggestion there would be to make sure that you have some crypto specific questions. So asking them, how do they detect crypto exposure and how do they respond to it? I mean, as we said, the vast majority of crypto activity is legitimate, just like traditional financial system or even cash. So you need some sophisticated controls and some well-designed controls to identify what is not legitimate and to take action accordingly, while letting legitimate activity continue. And I might ask you a question now, Danny. I think we had a question come through during registration as well, which maybe you'd like to answer in our last few minutes.
Sure.
So thinking about recent enforcement actions, what do you see as the most common gap between having a compliance program that looks good on paper and one that regulators view as genuinely effective? So to put this another way, this is about, designed well, but is it operating effectively? And what is the difference between them?
Great question. And I'm actually going to combine this with another question that came in on, have there been recent actions taken against financial institutions as it relates to reporting fraudulent activity? And the answer is yes, because just this month, FinCEN fined Canaccord $80 million, which was the largest penalty ever imposed against a broker-dealer for violating the BSA. And one of the things that FinCEN highlighted in its press release is that Canaccord failed to timely detect and report numerous securities fraud schemes that caused significant economic harm to investors. And one of the reasons that FinCEN pointed out for this was the lack of effective training. So Canaccord did implement AML training, but employees did not have sufficient tailored training on how to identify red flags or on the AML risks inherent to Canaccord's business. And this is a common gap identified by regulators. The compliance training program looks adequate on paper as a check-the-box exercise, but it isn't actually effective in practice. Catherine, I don't know if you have anything to add to that before we wrap it up.
I would just add a couple of points. You touched on fraud, Danny, and I think we've seen some questions about, well, what are regulators doing about fraud? Like we see these huge penalties for money laundering, but what about fraud? And I think traditionally fraud has been almost seen as like an operational risk and cost for the institution. So if it doesn't have adequate fraud controls in place, then it experiences losses. So that's, kind of consequences for its own failures. We see regulators take action where there are external parties who are targeted by that fraud. So investors, for example, if a company is defrauding its investors. But what we are increasingly seeing is regulatory expectations that financial institutions will take responsibility for protecting their customers from fraud as well. So fraud awareness programs that help customers understand how to protect themselves. And with the closer links between money laundering and fraud and cyber as well, I think that distinction of, fraud is an internal operational risk and loss for the business, not something for regulators to take action. I think we may see that change.
Okay. Good point. So this brings us to the end of the webinar. I do want to note that we have a couple of other great webinars coming up in May. So on May 13th, we're going to cover training program effectiveness and best practices. And on May 21st, I'm going to moderate a panel of experts on the Financial Action Task Force's mutual evaluation process, which several of our clients have been asking about. We've included links for the registration, I believe, in the chat, and we'll include them in a follow-up email and on our LinkedIn page and website. Thank you, everybody, for joining us. Have a great day, and we look forward to connecting again with you soon.